In the second quarter, Goldman Sachs posted another record trading profit for their firm. Trading profits doubled over the last 12 months, an enormous increase in trading profits of stocks and other asset classes for Goldman Sachs. But recently, according to filing disclosures, Goldman Sachs has aggressively and also quietly sold an enormous amount of their stock portfolio that the firm owned. So since December, Goldman Sachs has sold about 25% of all shares that the company owns. How did they do it without lots of people noticing? They did it with something called a dark pool. A dark pool is legal, and it is an anonymous and also privately organized financial forum where large banks can trade enormous blocks of stock without it being painted on the tape at the New York Stock Exchange or elsewhere. And that is how a very large firm or a large trader or a large pension fund or a large mutual fund, if they want to unload massive amounts of shares very quickly or buy massive amounts of shares very quickly, that is how they can do it. They can do it in a dark pool. Now, a lot of trades often don't go through dark pools. Normally, when pension funds or hedge funds accumulate enormous share positions of stock, they do it slowly over long periods of time, because otherwise it will move the stock price up way too much, way too quickly. And then the pension fund or mutual fund is bidding against themselves to buy stock, paying higher and higher prices. Now, in the case of Goldman Sachs, I think this is a warning sign that Goldman Sachs thinks that there's too much leverage in the system and that the stock market has made all-time nominal highs, way too many of them, way too quickly. And that valuations on a lot of these large cap stocks are insanely high, especially with what we're seeing lately with junk bonds and credit being removed from the system, whether that's China or Wells Fargo Bank, and the bullshit excuse that Jamie Dimon of JP Morgan gave about why the firm is holding so much cash, and then also the margin calls that JP Morgan is giving to their hedge fund customers. So there's a lot of red flags in the system that credit is slowly being pulled out, and yet Wall Street is selling more and more and more junk bonds and toxic garbage. The other red flag is also that junk bond yields are now below the CPI inflation rate, which is totally ridiculous. And I explained that in a video in the last couple days. So Goldman Sachs has not entirely liquidated all their stock position, but they have drastically reduced their net longs on share position. They're probably setting up more long vol strategies, more hedged strategies, because the leverage short vol trade is way overcrowded, and being long volatility is probably a good hedge right now, especially if the Fed actually does try to hike rates a quarter point in the not too distant future. Although I suspect that they won't, but the Fed may actually try. They're at least talking about it pretty much every day, Monday through Friday for the last 6 weeks. There is a Fed governor or someone from the Treasury Department or Jerome Powell himself at least discussing hiking rates or tapering QE. But that's not what the Fed's balance sheet is actually saying. The Fed's balance sheet is up enormously since early January. The Fed's balance sheet is up another $104 billion in just the last week. You're seeing a lot of signs that despite the stock market indexes making what seems like all-time highs almost every day or every couple days in nominal, that a lot of smart money is selling large positions of their shares into the rally. There's also a lot of cross currents and divergences that confirm that not all companies are participating in this bull market, in this stock market rally. So there's a lot of divergences there. A lot of small caps are not benefiting from the general stock market indexes going up, and small caps reflect the real economy, Main Street, more than large corporations that are getting bailouts and unbidden government contracts and artificially cheap currency and credit from the Federal Reserve Bank and from Wall Street banks to do leverage buyouts and share buybacks with debt and other shenanigans. So if you want to read more about dark pools, articles with the definitions explaining them will be below this video in the information description section. But bottom line here is that smart money is starting to take profits off the table and probably setting up long vol, and hedging strategies. And that means more money is probably going to cash in case of a stock market crash. People will probably be going into US Treasuries, and also smart money is going into gold. Central banks are buying physical gold, and that means that the Bank of International Settlements derivatives department has to smash the paper gold price, so lots of tonnage of physical gold can be transferred to central banks that haven't bought gold in 10, 15, 20, 30 years. And that's what you're seeing in the IMF and World Gold Council data, is that central banks that have not bought gold in the last 10, 15, 20 years are buying large tonnage orders, 10, 20, 30, 40 tons of physical gold in a month. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content, research, financial education, and analysis than I could provide in this short little free video, because Google AdWords revenues do not pay any of my bills, my patrons do. So thank you very much for being a patron if you are one. There is over 170 articles, charts, and audio podcasts behind the paywall, including 17 new articles out in the last 7 or so weeks on a lot of interesting topics about global macro companies and sectors. I think it is one of the best deals out there. The cost of a bad cup of coffee. You can get premium content, which in my space I'm charging less than anyone else, far less than anyone else. So if you'd like to try that, I think the risk is worth the reward. It's only $5 a month. A free sample would be the 45-minute Nolan Watson interview that I released in the last week or so. That was behind the paywall for patrons for about 6 weeks before I released the interview for free. And there is similarly in-depth articles on a lot of interesting topics behind the paywall on mining companies, royalty and streaming companies, oil companies, and global macro, including why the dollar is rallying despite the Federal Reserve's balance sheet increasing so much. It's a lot more complicated than other global macro experts like David Hunter and others would have you believe.